Good morning, everyone. Let me just drop this down. I hope you're all doing well. It's Monday, December 11th, as we have it, and there's a few things to cover here to start the week because, first and foremost, we have a contract rollover in the equity market. So that suggests that we're no longer trading the December contract. When we take a look at the S&P, NASDAQ, right, so on and so forth, which is the Z23, and we're rolling over into the March because the March has more volume, the H24, so the numbers are going to be skewed. They're going to be higher than what we're used to over the last few weeks. And not to alarm, right? Markets haven't gapped higher 50 points. It is the rollover. So the first thing that I do want to talk about, because pretty news driven, it's like front loaded on the news, right? Well, I guess midway through on Wednesday we have a big news event realistically. And we're going to have to keep an eye out on that because that could be the turning point in these markets, right? That could be a catalyst to propel some of this downside as we've seen this constant upside equity market. Now, one of the things is that I want to caution people against I should caution people about the potential downside movement because right now, how the positioning runs is that we're still looking for the upside momentum into January, mid-January, as a lot of big money is positioned for the upside. So I think it's going to be very difficult to catch that top, and it's going to be more of a lack of buyers and aggressive sellers that come in and turn this market. So keeping all that in mind, we've got, to begin the week, we have the CPI data that comes out tomorrow pre-market, which is the inflation gauge, and we're going to see how that does shape up because it's going to impact how the equity market moves. Now, leading into that, I can expect a little more upside. I think that we're not done peeking our heads above these rotations on the S&P specifically. NASDAQ and tech is lagging a bit, but we'll take a look at the ES market later on in this session. But first and foremost, right, the Federal Reserve is starting their meeting minutes for their rate decision on December 12th, Tuesday, but the main event is going to be the 13th on Wednesday, right? A lot of eyes are going to be on this to see how we have changes in the monetary policy, the dot plots, and also the rate change, right? There's an expected rate change, right? It could also stay the same, which is, as you can see on the screen, if you go to FedWatch Futures, there's a 98.4% chance that we remain as is in this meeting. So the European Central Bank, the Bank of England, Swiss National Bank, and the Norwegian National Bank are going to meet on Thursday, actually. The Fed is widely expected to hold its federal funds target steady at the 5.25 to 5.5 range for the third time, and most market participants are actually betting on a rate cut to come in May, right? Starting in May. Now, I think it was last week or 2 weeks ago that the expectations were about like 65% that we see that first rate cut in March, which caused a pop in gold on the overnight on the Sunday session before it was quickly pushed back down. So Goldman Sachs expects the Fed to cut twice next year, with the first expected in Q3, earlier than its prior outlook of rate cuts starting next December. So the Bank of America also projected that the Fed will start cutting rates in June, and Morgan Stanley sees mid-2024 cuts. Deutsche expects a central bank dot plot to avoid cuts in the first half of 2024. If we take a look at these expectations here in the FedWatch Futures, you can see that the January meeting, 2024, the first meeting at the end of last day of January, there's a 94, almost 95% chance expected that rates stay the same. In March, we start increasing the odds of a cut, right? Right now, there's about a 38. Well, if we combine these two, there's about a 40% chance that we get at least one cut. In May, there's about a 72% chance that there's one cut in May. So by June, there is a very, very large majority that we will have cut at least 25 bips by June 2024. So generally, economists are worried about two major policy risks. One is that the Fed waits too long to ease policy in the policy to ensure inflation remains low, meaning that higher interest rates would weigh on economic growth, risking a recession. And the other is the Fed could cut rates prematurely while inflation remains above its 2% target. While stronger than expected labor market tempered bets of rate cuts starting in March. So the recent disinflationary trend has been encouraging. The retail inflation was unchanged in October, while the core PCE, the Fed's number one gauge, their preferred inflation gauge, reached its lowest level this year. So markets are now waiting to see what the CPI has in store, which comes out on Tuesday, as I said, pre-market, and we'll see how this affects the overall market. So general standstill in rates won't necessarily affect the market movement, but it's more so what the projection and what the Fed does say on Wednesday that everyone is going to have their eyes on. So I think that's going to be the most appealing aspect, especially with the dot plot, seeing their projections, right, seeing when they're expecting to cut, seeing their stance on inflation, their dovishness or hawkishness is going to have the opportunity to push the market around into the afternoon session. So as I look at this now, I don't want to guess, I don't want to estimate, but CPI is probably going to come out lower than expected, putting some downside pressure, or as is, right, as expected, putting some upside pressure in this market before maybe, right, there could be some kind of catalyst around the Fed CPI that tops the market out temporarily for that pullback into next week before we start catching a bit into the end of the year and into March. That's generally what I'm expecting based on how this market movement has been shaping up. I think there's just a continuous push of buyers that are getting into this market rather than the lack of sellers to consider as we are. A lot of people are trying to find tops in this market. I don't think necessarily that's the way to go about it. Just wait for distributions to accept lower and lower, but otherwise I'm just going to keep on the trend. So if I'm looking at the H figures, right, on the S&P 500, the H contract, what I'm going to be looking at is into that mid 40, right, 46.40 area, mid 40 is going to be an interesting area for me to see if some of those buyers are going to come in, right? Mid to low 40, that's my main target area for the longs to come in. And then we have that low 30 as well as the low 20. Low 20 is a pivotal area. I don't want them to let go of the low 20, but I would rather see if I was a strong buyer, 46 like 30, 32, 33, or 46 like 43, 44 to hold out for that buy side to continue this trend higher. There's a lot of resistance into this mid 60, 46 mid 60s, and then 46, 75, 76. There's a lot of resistance there that we have to keep in mind, but I think that leading into this news, we have this slow trickle up higher, especially in tech, before we get kind of smacked with some kind of reality. So that is mainly what I want to take a look at to start the week, what I want to break down today. I hope that everyone has an amazing Monday, right? Great start to the week, and we'll do this again tomorrow. Check out our live trading, which we're going to open right now at community.tradeproacademy.com. So we'll see you guys all there.